Hi everyone. In this video, we are going to dive into one of the most important financial statements, the statement of cash flows. So, what is it? Put simply, the statement of cash flows provides a summary of all the cash that came in, which we call cash inflows, and all the cash that went out, our cash outflows, during a specific reporting period. The difference between the two is our net cash flow. But just knowing the total change isn't enough. A company is a complex thing. We need to know why the cash changed. Did we make a ton of cash from our customers but spend it all on a new building? Did we have to borrow money just to pay our employees? To answer these questions, the statement breaks all cash transactions into three distinct categories. This is the most important concept to understand, so let's get it right from the start. The three categories of cash flows are operating activities, investing activities, financing activities. When we add up the net cash flow from these three activities, the total will perfectly equal the total change in the company's cash from the beginning of the period to the end. Let's break down each category. First, operating activities. These transactions are related to the primary day-to-day revenue-producing activities of the company. Think about what's on the income statement, revenues, and expenses. Operating cash flows are the cash effects of those same activities. Cash inflows from operations would include collecting cash from customers, providing services, or even receiving interest or dividends from investments. Cash outflows would be things like paying your suppliers for inventory, paying your employees' salaries, paying for rent, paying interest on your loans, or paying your income taxes. Second, we have investing activities. This category is all about the purchase and sale of long-term assets and other investments. Think of these as the major long-term items the company buys to grow and operate, or sells when it doesn't need them anymore. Cash inflows from investing come from selling things like property, plant, and equipment, maybe selling a delivery van or an old building. It also includes selling investments in other company stocks or bonds. Cash outflows are the opposite, purchasing that equipment, that building, or those stocks and bonds. Third, financing activities. This category includes all transactions with lenders and with the company's own stockholders. This is all about how the company raises its capital and how it returns it to those who provided it. Cash inflows from financing happen when the company issues its own stock to investors or when it borrows money by issuing a note or a bond. Cash outflows include repaying the principal on those loans, buying back its own stock, which we call treasury stock, and, very importantly, paying cash dividends to its stockholders. Now, here's a common pitfall I see students make all the time, especially with dividends. Remember this. Dividends received by the company are classified as operating. We classify them this way because they are part of the company's regular operations, similar to collecting interest. Dividends paid by the company to its own shareholders are classified as financing. This is a return of capital to the owners. Okay, let's see how this looks on a real statement. Here is the statement of cash flows for a company called eGames Incorporated. You can clearly see the three sections we just discussed. Under cash flows from operating activities, it starts with net income and makes several adjustments to get to the net cash flows from operating activities of $50,000. Under cash flows from investing activities, you see the purchase of investments, an outflow, and the sale of land, an inflow. The net result is a cash outflow of $29,000. And under cash flows from financing activities, we see the company issued common stock, an inflow, and paid cash dividends, an outflow. The net result here is a $7,000 outflow. When you add them all up, $50,000 from operating, minus $29,000 from investing, minus $7,000 from financing, you get a net increase in cash of $14,000. And look at the bottom. The company started with $48,000 in cash. We add the $14,000 net increase we just calculated, and we end the period with $62,000. It all balances. Now, look at the very bottom of that statement. There's a note, non-cash activities. This is a critical concept. Sometimes, a company has a significant investing or financing transaction that doesn't involve cash at all. For example, what if eGames purchased $20,000 worth of new equipment, but instead of paying cash, it signed a long-term note payable directly with the seller? No cash changed hands. Therefore, it cannot be on the statement of cash flows itself, but this is a significant transaction that investors need to know about. So, we disclose it in the notes to the financial statements. Other examples would be issuing stock to purchase a building or converting bonds into common stock. Finally, you might be wondering, where does all this information come from? To prepare the statement of cash flows, we rely on three main sources. The income statement for the period, which is the starting point for the operating section. The balance sheet. Specifically, we compare the changes in all the asset, liability, and equity accounts from the beginning of the period to the end. And of course, the detailed accounting records, which give us the specific details we need for each transaction. This diagram shows the relationship perfectly. Revenues and expenses from the income statement, plus changes in current assets and liabilities from the balance sheet, all flow into the operating activities section. Changes in long-term assets drive the investing activities section, and changes in long-term liabilities and stockholders' equity drive the financing activities section. So, to recap, the statement of cash flows explains why a company's cash changed by classifying all cash transactions into three buckets: operating, investing, and financing.